Good morning. This is James with 77 Financial Group. You're listening to 15 Minutes of Finance, where in the next 15 minutes, I bet I can get you excited about investing. Let's do it. All right. Happy Saturday morning, everybody. We are here at the crack of dawn, and by crack of dawn, I really just mean 8 a.m. on a Saturday. I've been up doing research for you guys. We have such a good episode today. We got content, we got creativity, and we got, what's another C word? Coolness. We got coolness coming today on this fine Saturday morning. We have story time today. We got story time and stat time, okay? We have news we got to go through first real quick, though. So let's run through the news. Then I got a custom-made original by James story for you guys. Tell your kids this story. Okay, this is a great bedtime story. Do you guys remember, I think it was called Animal Farm. I don't really remember. Guys, listen, earlier school years were not my thing. I was a much better college student than I was a high school student. But there was a book called Animal Farm, I think, and it's where the animals could talk. And the whole time you're just like, what is going on at this farm? Why are these animals able to talk? And it was one of the only books, that and Hatchet. If anybody remembers Hatchet, that was a fire book. Animal Farm and Hatchet. But in Animal Farm, these animals could talk. And eventually your teacher's like, yeah, this is a allegory or a analogy, whichever one it is, for political turmoil in the country, in the world. It was like one of the animals was Russia, and then the keepers, the farmers were Germany or something like that. I don't really remember, but I wrote my story off of that today. Okay, so hopefully you find it to be as thrilling as Hatchet or Animal Farm. But okay, let's get through this news here. Okay, major U.S. equity indexes tumbled after Friday's inflation report came in hot and consumer sentiment weakened significantly. The S&P 500 lost 2% in this week's final trading session. The Dow closed 1.7% lower, while the Nasdaq plunged 2.7%. All three key market gauges ended the week in negative territory as the signs of persistent inflation and consumer pessimism exacerbated concerns about escalating tariffs and the trajectory of the economy. Lululemon shares suffered heaviest losses of any S&P 500 stock, plummeting 14.2% after the maker of yoga pants and other workout attire released its quarterly results. Although Lululemon topped sales and profit estimates for its fiscal fourth quarter, the apparel company issued lower than expected guidance for the current quarter and full year. Executives cited a downturn in traffic as customers limit spending in uncertain economic environments. JP Morgan analysts cut their price target on the stock, noting that tariffs and currency exchange could affect and weigh on the profit margins. Warner Bros. Discovery shares sank 5.8% following a report in the New York Times about CEO David Zaslav's struggles to revitalize the entertainment giant's film studio, noting that ticket sales for its movies remain 40% below 2019 levels. The entertainment giant also announced a reorganization of its streaming content acquisition teams as it aims to align its strategy for its first two streaming services, Max and Discovery Plus, across all regions. Shares of Dollar Tree slipped 5.5%, giving back a portion of the strong gains posted since the discount retailer announced earlier this week that it would sell its Family Dollar brand for $1 billion. Crazy. $1 billion for just a chunk of their business. Although analysts indicate that Dollar Tree is in a good position to attract value-conscious customers and could see earnings boost following its separation from Family Dollar, they pointed to the potential tariff-related headwinds. W.R. Berkley shares surged 7.5%, notching top performance in the S&P 500 and reaching a record high after the insurance firm announced that Japan Mitsui Sumitomo, MSI, would acquire a 15% stake in the company. According to a statement, MSI will purchase shares on the open market and from other third parties as it accumulates its position. The news release indicated that the agreement will not affect the firm's day-to-day operations. Shares of Welltower, a real estate investment trust, REIT, focused on medical facilities and other healthcare infrastructure, added 2.3% after credit rating agency S&P Global upgraded its issuer rating. Welltower has improved its balance sheet and is expected to see additional improvements in its credit metrics over the next 2 years. American Water Works, ticker AWK, The largest regulated water and wastewater utility in the U.S. announced a plan to invest around $40 billion in its national infrastructure over the coming decade. Shares of the company advanced 2.2% on Friday. Okay, I could hark this from the mountaintops here. Companies you've never heard of, like American Waterworks, AWK, and maybe if you're older, you've heard of it, but I doubt anybody who's listening between 30 and 45 has really heard of American Waterworks. That is one of some of the best investors in the world. Warren Buffett, Peter Lynch, Ray Dalio, Tom Lee, all these guys. They do try to find companies that nobody's ever heard of, but that are just killing it on their balance sheets, on the fundamentals of their business, because that's what matters the most. Not that there's notoriety and that it's name brand. Now, eventually you would want a company to become really successful, but to find companies that nobody knows that are set to explode, that is where there's immense value in working with a professional. AWK, I've never heard of them, okay, but they're investing $40 billion. So imagine how much money they actually have, which is ridiculous. Okay, we got to get to the story, guys. We got to get to the stories, and then we got to get to the stats. So I'm going to read, excuse me. I got to get my reading voice in. Okay, here we go. This story, guys, is called The Tale of the Three Farms. Okay, it's an original by yours truly. Once upon a time, in a vast, fertile valley, there were 3 farms that fed the surrounding lands. The first was called Green Valley, known by all as the Everything Farm. With 20 workers living and laboring on its land, Green Valley grew nearly every crop under the sun. Lettuce, carrots, tomatoes, onions, potatoes, apples, peaches, and more. It was a beautiful, bountiful, large, and generous farm. To the north was Dwight Stone Root, a beet farm run by 5 hard-working folks who had been there for generations. Their soil was perfect for beets, sweet, rich, and earthy. And so to the east was Golden Acres, a wheat farm, also with 5 people who grew golden stalks that danced in the wind. For centuries, these 3 farms traded with each other and other surrounding individuals. But the smaller farms, Stone Root and Golden Acre, had a rule. If you want one of our beets or bundles of wheat, you must give us 2 heads of lettuce or 2 baskets of tomatoes. That's just the cost. And though Green Valley grew plenty of everything, it never charged the smaller farms more. You want onions? Yeah, you can take them. Tomatoes? 1 for 1, no problem. Lettuce? Sure, why not? We all like a good head of lettuce. We've got more than enough. The folks at Green Valley believed it was better to help than to haggle. The older generation said, it's just the way it is. We're big. We can afford it. This is what we do. We want to be good people. They need us. And so it went for decades. Until time did what time always does. The old farmer passed, then his son, and finally the farm fell to a grandson named Jack. Jack had grown up running through the rows of lettuce, playing tag amongst the trees, and he remembered the barter games with kids from the other farms. 1 beet for 2 lettuces, they'd say. But why? I only brought 1, Jack would argue. Because that's the rule, don't you remember? And they would sit there laughing at him cruelly. Jack never forgot that feeling, nor the bitterness of losing out, nor the sour taste of unfairness. Years later, now the head of Green Valley, Jack called a meeting with the other farm leaders. He stood tall, dusty boots planted firm in the soil. We've been trading unfairly for centuries, Jack said. You charge us double, but we've never done the same to you. That ends now. The beet farmer frowned. It's always been this way. The wheat farmer crossed his arms. You can afford it, Jack. But Jack shook his head. Not the point. If I give you 2 lettuces for 1 beet, then from now on you give me 2 beets for 1 tomato. Or better yet, let's call it even, 1 for 1. Fair trade. How does that sound? He paused and looked across his fields. Well, we'll just grow our own beets and our own wheat. We've got the land, the people, and the know-how. It'll cost us at first, yeah, sure. But we're done being taken advantage of. We've got the people and we've got the will. You guys have been ripping us off and we're tired of it. There was silence in the valley. The other farmers had a choice. Remove the tariffs, trade fairly, and keep the relationship strong, or lose their best customer forever. And from that day forward, the valley learned a truth many had long ignored. Kindness is not weakness. Generosity is not permission. Trade must be fair, or eventually the big farm grows its own beets. Do we clap now, or what do we do? We give a little clap. Guys, I was thinking, what is the best visual way to explain tariffs? And Animal Farm came up, and I was like, oh yeah, what if we did it like a farm? And guys, the USA in that story, I know you understood that. It's a great visual of understanding how tariffs work. We're the big farm. The U.S. is the big farm. We can choose to grow our own food, our own beets, our own wheat. And yes, at first, and I promise you right now, in the stage that we're at, this Q1, almost Q2 of 2025, is that at first, quote unquote, at first stage. It'll hurt us at first. And boy, is it hurting. Okay. But then guess what happens? That harvest comes. That harvest comes and everybody wants what we got. And I promise you, two things will happen. Either we become super self-efficient and we actually don't need to trade anywhere, or they remove their tariffs and they start trading with us. Okay. Because one of the things that we could do as the farm, the big farm, is undercut the other two farms' prices, right? We already sell everything. We already have everything we need. So if we're going to start growing beets and wheat, well, we have enough going on that we can just say, let's charge 10% less than those other guys. And that is the power of tariffs. And I am very thankful that the good guy in the world, arguably, comparatively, right? We're not Superman, right? But we might be Batman, the vigilante, kind of doing gray stuff. I'm glad that the good guy has the power to utilize tariffs and not, evil dictator countries. So at least on the scale that we're able to use it. Now, I wanted to bring that up because that visual, that story, that amazingly well-written, phenomenally sounding story, because I was looking at some stats yesterday. Yesterday we dropped 2%. That's so hard for me to see. So hard for me to see. I don't like it. And it's not even, a lot of it's not even my money, right? A lot of it is client money, but I care about their money second to them. There's probably no one, not a single person in our clients' world, outside of maybe their immediate family, that cares more about their money than me, because it's my job. That's what I'm selling myself on, that I'm going to take care of your money. So when things go down 2%, I hate it. And it is stressful, but it's also like, okay, this is a part of the process. Like, did we build great portfolios? It's a constant reminder of the process and everything that we're doing. And it also, I wanted to go through historically. I went all the way back to 1943, and I wanted to look at the drawdowns. Okay. A drawdown is just like the worst period of a portfolio. So meaning if last year it said, or let's do, what would be a good year? No, last year's fine. I didn't get a stat for last year, but I went up to 2022. Last year, the stock market did like 25%. Well, there was a period of time during that year where the stock market went down 5%. It might have even gone down more. I would have to double check. But the point is that there was a drawdown amidst that climb to 25% green on the year. So a drawdown. I wanted to look at what the drawdowns are, because if you remember, just about 2 months ago, we were at all-time highs. And so now we're in a drawdown period. Some of these numbers are crazy. Okay. Some of these numbers are absolutely ridiculous. So let's look at, where's the Great Depression? It's 1931. Oh, I didn't go that far. Sorry, guys. My bad. Hold on a minute. I got to look at my own data. We'll look at 2008. Okay. 2008 did negative 48%. Okay. Then 2009, that was the biggest drawdown. And then 2009, the biggest drawdown was negative 27%. Okay. So now if I go over here and look at what 2009 actually did, and I did ranges for this because I was able to find a chart that showed worst drawdown in the year and then what the year actually did. And so based upon metrics, 2009 was between 20 and 30% in the green. Okay. So think about that. The worst year, or the worst drawdown in 2009 was 27%. and then it bounced to the green in the 20 to 30%. So we'll just call it 25. That's a 50 plus percentile range that it bounces in between. Okay, and now we can look at 2022, negative 23%. Okay, negative 23%. And then we go over here and look at how the year ended, and it was down between 10 and 20%. Okay, so I wanted to end it 2022 because 2023 we had a green year, and 2024 we had a green year. And I wanted to show that even during these worst periods of time, okay, these massive drawdowns, and a drawdown is just the largest dip it took from a point, okay? Meaning, like, if it's at 5,000 and it goes to 5,500, okay, but then it goes down to 4,900, that's a 600-point dip, if that makes sense. So that's the biggest drawdown. But then if it ends back up at 5,500, then that's its actual rate of return, because it started at 5, so it had a 10% rate of return, if that makes sense. I'm not doing great with that visual, but I promise you statistically that these drawdowns that we're having because of these tariffs are a drawdown, and it rebounds almost immediately. Okay. I'm looking at, and I'm going to put this podcast into a blog post with these visuals that I got, because I'm looking at some of these years. Some of these years look horrible. 2020, negative 34. 1973, negative 23. 1974, negative 38. 1998, negative 19. 2001, negative 29. 2022, negative 33. And you see all these numbers. Almost none of those years weren't necessarily red. That was just the largest drop down in that year. Okay, so it can fluctuate significantly in a year, even in a green year, and hopefully that makes a lot of sense. And then I also, in this graph here that we found, $10,000 invested in 1943, despite all of these worst calendar drops since 1943. It's $57 million. Okay. So what does that mean? It means that when you don't try to time because you're not good at it, okay, you're just not. Maybe, okay, 1% of you is good at it. 0.01%. It's like Lysol. Okay, 0.01% of you is good at this. 99.99% of the time, we're not very good at this. Okay, even the people in my world aren't good at it. That's why they do not, a lot of people that buy and sell stocks, they're for like their business, for their mutual fund or as a hedge fund, they're not doing it to get the most return possible. Okay, they're actually doing it because that's part of the fund's goal. And that gets very confusing, but you would think every person or every company or person, their goal would be to make money, make as much money as possible. That's not the case. In fact, that's less than like 10% of funds or managers in general. Yeah, look, these drawdowns are significant, but it doesn't matter because if you would have just stayed, you'd have $57 million if you invested in 1943. So I hope that visual makes a lot of sense, guys. The truth is, with these tariffs, we're feeling it, okay? And this is the part of growing the wheat and growing the beets for the farm. Okay, for the big farm, and we're the big farm. So we're in the process of growing those right now. And once that's done, two things are going to happen. Okay, and it actually we might not even have to wait until it's done. It might happen earlier. The other two farms, representing any other country we're in a tariff war with, they're going to come to the table because they want to be able to sell their stuff too. All right. Hopefully that makes sense and gives you a little bit of peace of mind. And I hope these stats about the worst drawdown and what actually happened in that year, I hope it gives you like, oh, this isn't real. Like a lot of this stuff is temporary in the moment and it's a feeling. It's not an actual event that has happened. The only time it's an actual event that will happen in your life is if you sell. Because when you have an investment that's already invested and you've got 20 years, 10 years, however long you have to invest, you have to remember that when you sell something, you now have another variable. You now have another variable of when to get back in. Okay? Now you have to figure it out again. And if you do know anything about gambling, adding parlays, you don't tend to do better when you add more things to bet on. Okay. So keeping it simple and remembering, hey, we bought a great company. Let's hold on. We don't need this money for a while. This is why we remember the plan, the investment strategy, and sticking to it. It decreases your odds of failure because you're not adding an extra variable in. Okay. All right, guys, that's it for me. I don't even know if I made any sense with these calendar drops, but this graph is pretty darn compelling. So I'll definitely put it in a blog post and allow you guys to take a look at it too. You can find that on our website at westonwalters.com. on the community tab. All right, guys, that is it for me. Please share this with somebody who has a problem with tariffs, or share this with somebody who loves stories. Okay, because I gave you a story today. This was story time with James. Yeah, funny enough, or not funny enough, but in all seriousness, thanks for listening to that. I know that was a little cheesy, but hopefully it was a great visualizer. Guys, that is it. As always, invest early, invest often. Have a good one.